So we're going to try to be very snappy about how we go about this. So quickly, I'm going to invite Mr. J.C. Dapar from Indeed Incorporated to talk to us about grooming budding actuaries, a collaborative tool app demo. And he's going to try and do this within 15 minutes. So George? So J.C. here.
Hello, lovely people. Good afternoon. When I joined the insurance industry some 13 years ago as a data scientist, I asked a simple question that turned out to be profound. What is the difference between the actuarial trend and the predictive modeling trend? At the time, few, if any, had mastery in both data science and actuarial science, and so I received no satisfactory answers. This curiosity sparked an inquiry to understand the question, but more importantly, unify both pricing models of both fields. I began to take actuarial exams to deepen my understanding of the actuarial pricing methodology. But it was not until I had taken the CAS Exam 5, which was on rate making, and then the CAS Exam 6, which was on reserving, and transitioned into a formal actuarial role that I began to understand the question and unify the models. Ladies and gentlemen, my name is J.C. Dapar, and I'm delighted to present to you my award-winning paper titled Rate Making Reformed: The Future of Actuarial Rate Making in an Era of Predictive Analytics and Big Data. I would like to highlight that even though the paper was published by the SOA, the award was jointly sponsored by the CAS, the SOA, and the CIA. And so it speaks about the general applicability of the paper's content. But before I delve into my presentation, a little bit about myself. I have worked in three main industries, predominantly in insurance, but also in manufacturing, and now in tech. In insurance, I worked on programs related to pricing precision, pricing optimization, and underwriting excellence. In manufacturing, I was charged with the responsibility of revolutionizing our business model with Internet of Things data. And you can think about Internet of Things data as telematics data. My other responsibility was propagating evidence-based decision-making across the enterprise. And now, I work for a company called Indeed, and we have a super noble mission of helping people get jobs. Yes. Yeah, get on Indeed.com. So I think it's now opportune to issue the general disclaimer that most presenters would issue, which is, even though I represent the CAS at this Congress, and even though I work for Indeed, nothing in my presentation reflects the view of my employer or the CAS, and any errors are solely my responsibility. I am going to talk about, or I'm going to make the claim that predictive analytics and big data are going to force the actuary to source all premium components from the GLM. And I use GLMs to symbolize predictive analytics solutions. And so even though I'm going to be talking specifically about GLMs, most of the things that I say about GLMs apply to most predictive analytics solutions. And so I hope I don't lose generality in my argument by emphasizing on GLMs. But before I go ahead and make my claim, I would like to talk a little bit about big data, but not so much about what big data is, because that would have been an interesting topic some 10 years back. I would like to talk about where big data fits in the historic account of world revolutions. So let's go back in time to the first documented world revolution, which would be the scientific revolution. This would be the era when Copernicus would replace the geocentric model with a heliocentric model. Galileo Galilei would provide empirical evidence to support the heliocentric model. Isaac Newton would publish his groundbreaking work on gravity called the Principia. Adam Smith would publish his groundbreaking work in economics, The Wealth of Nations. There was so much knowledge exploration and knowledge discovery that the philosopher Immanuel Kant called it the Age of Enlightenment. And it's the Age of Enlightenment that propelled the next revolution, which would be the Industrial Revolution. So the way I characterize the Industrial Revolution is the era when we would invent mechanical power, right? The loom machine and the steam engine would be invented. And it allowed us to transition from a purely agrarian economy into a multi-industrial economy. And then, early 20th century, an engineer called Frederick Taylor would come up with a very revolutionary paradigm called scientific management. And scientific management, you wouldn't normally hear about it when we are talking about revolutions, but if you think about its impact on the world, it's significant. So Frederick Taylor was the first person to collect detailed manufacturing data and think hard about how to organize people around machines in order to optimize production. And if you think about how the current corporate entities are structured, we took a lot of inspiration from scientific management. In fact, another engineer called Bill Deming would be inspired by this paradigm to invent another elegant engineering paradigm called just-in-time production. And then, middle of the 20th century, we would invent another machine. This time not mechanical, but cognitive machines. The only problem with these machines were they had finite cognition, so they did not have the infinite cognitive abilities like human judgment and human creativity. And then, late 20th century, early 21st century, the internet is born, and the internet is propelling two main revolutions. The big data revolution, which is an explosive increase in the data that we are generating, and the AI revolution. And if you ask me, the AI revolution has got two main objectives. The first one is to develop mechanical ways of analyzing data for actionable insights. The second objective is loftier, which is to teach machines these infinite human cognitive features of judgment and creativity. I think the second one is much more exciting, but we have a long way to go on that. I'm not going to dwell too much on this topic, but the following slide, like I said, I'm not going to talk about what is big data. The following slides are talking about how ubiquitous big data has become. It's in our cars, it's in our homes, it's in our healthcare, it's everywhere. But let me not hide from the question that I want to answer today, which is, the claim that I want to make today, which is big data and predictive analytics are going to force the actuary to source all premium components from the GLM. And I'm going to make this claim by making two main points. The first point is our current rate-making culture was born out of expediency, not for efficiency. That's the first point. The second point I would make is that the GLM is the most precise, is the most efficient source for all premium components. So let's get into it. All right. So let's start with the formula for premium. Premium can be calculated as a product of three factors: base rate, proposed rate change, and policy risk factor. There is nothing controversial about this, right? The current approach, we get the base rate and the proposed rate change from the actuarial indications process, and then we get the policy risk factors from the GLM. I am going to make the argument that all three components should be sourced from the GLM. All right? So let's get to my first argument, which is our current rate-making culture was born out of expediency, not for efficiency. To see this, think about the first actuary. this actuary would just be making base rates, right? But then it wouldn't take him long to know that not all policies are the same, and so he would have to vary premiums by policy risk characteristics. But then he does not have any technology to do that, so what does he do? He invents a very simple methodology, univariate analysis, to calculate the risk relativity factors. So if you think about it, univariate analysis started the culture of getting the base rate from one shop and the risk relativities from another shop. But very soon, the actuary will realize that there is a very serious problem with univariate analysis, which is it double counts correlated effects. And so he'd be in search for a more accurate methodology. And then he comes up with the Bailey's minimum bias procedure. The Bailey's minimum bias procedure resolves the double counting of correlated effects, but it has two main defects. The first is its computational cost and complexity increase exponentially with the size of the risk, with the dimension of the risk variables. The second defect is much more subtle, which is it only produces risk relativities. It does not produce base rate. And so Bailey's minimum bias would cement the culture of deriving the base rate from one shop and the risk relativities from another shop. And so when we came across generalized linear models, GLMs, even though GLMs produces both base rates and risk relativity factors, and I'm going to argue they are the best source for all these factors, we only use the GLMs for the risk factors. We threw away the base rate, right? And so I'm going to make the point that we should the GLM is the best source for all premium components. But before I do that, let me talk a little bit about GLM so that we can build a uniform understanding among ourselves. So the GLM is as follows. The expected value of your dependent variable in an actuarial predictive modeling, your dependent variable is normally a loss variable. It's either frequency, severity, loss ratios, loss cost, right? So the expected value of your loss cost is specified as a function of your risk variables. If you are pricing an auto insurance, some of your risk variables would be the policy tenure, the driving score, right? The vehicle type, and so on and so forth. GLMs have got many advantages, and I'm going to spend time on only a handful. The first is that it affords us with a wide variety of distributions to fit our dependent loss variable. And in insurance, we have one of the most complicated dependent variables. Loss cost has got a probability mass at 0, and it's continuous thereafter. Not many modeling technologies would give you the capability to model such complex, mixed, discrete, and continuous distribution. But GLMs has got a distribution called Tweedy distribution, and if you parameterize the Tweedy well, it's able to fit that discrete and continuous distribution. The second benefit of GLMs is it allows us to maintain the multiplicative structure of premiums. In insurance, one of the things that we cherish is we get our factors, we multiply them together, and then we get our expected losses, right? GLMs has got a feature called the link function, and if you specify the link function to be log, you maintain the multiplicative structure of premiums. Okay? The third benefit is GLMs provides us with diagnostics to tell whether our parameter estimates are noise or signal. This is a very important utility because we like to drive a risk-based pricing strategy. But how are you going to drive a risk-based pricing strategy if you don't have any diagnostics to tell you whether the relationship between a risk variable and your targeted loss is due to chance or is due to signal? So having these diagnostics are really important. The fourth point is it's a maximum likelihood estimate. And in statistics, it's been proven that maximum likelihood estimates are one of the most precise estimates you can ever get. Right? They are one of the most precise estimates you can ever get. For the sake of time, I'm not going to go into the proof, how you prove that, but take my word for it. The fifth benefit is GLMs are actually very transparent. They are very interpretable. The actuary would be able to assess the impact of the risk variable on targeted losses. If your risk variable increases by 1 unit, you would know how your expected premiums are going to change. So it's very, very transparent, very, very easy to understand. And insurance pricing is a front-end product. It affects customers, so we want to make sure that we understand the technology we are using to drive these prices. And then the last point that I'm going to make is it produces both base rates and risk relativities, right? And so I think I'm going to go to my next point, which is the GLM is the best source for all premium components. So let's start with the base rate. The intercept term of a GLM is the base rate. Like the GLM obtained in the actuarial indications process, it can be varied by any dimension that the actuary wants, by city, by country, by vehicle type, whatever. You can vary it by any dimension that you want. However, unlike the base rate derived from the actuarial indications process, it has at least two main benefits. The first is you would have diagnostics to tell whether your base rate is signal or noise. And this is not a utility to take for granted. A behavioral psychologist, Daniel Kahneman, and I must say, a Nobel Prize-winning behavioral psychologist, Daniel Kahneman, talked about a study in which expert statisticians could not tell whether an estimate from a given sample size was signal or noise, right? So if expert statisticians are struggling with whether an estimate is accurate or not, I believe it's a fair assumption that actuaries would struggle to determine whether their base rates are noise or signal without any diagnostics. So this is important. The second benefit of GLM base rate is it's unbiased. We can't say the same for actuarial base rate. In fact, we know that the actuarial base rate is likely biased. And I'll show with an example. Suppose that you are deriving a base rate for a city with a disproportionate number of risky drivers. Your base rate is going to pick up this distribution of risky drivers. So if you multiply this base rate with the risky driving factor, you have double penalized the risky driver, one through the base rate and another through the risky driver driving factor. So we know that the actuary base rate are biased. However, with the GLM, because the GLM estimates all parameters simultaneously, it's able to take into account the correlations between them and reduce or eliminate any biases. Next, the proposed rate change. There are three main reasons why we need a proposed rate change. There are three main reasons why the current base rates becomes obsolete, and then we have to multiply by a rate change. The first is continuous changes in the external environment due to regulation, due to technology, or due to economics, due to cost of insurance, right? But for this dynamic, for continuous changes in the external environment, you could easily contemplate it by including an econometric trend term within your GLM. In fact, I have another paper coming out that talks about how to accurately incorporate econometric trend terms within a GLM framework. So check it out when it's published. The second reason why we need a proposed rate change is changes in business mix, right? But then if you are using a GLM to price risks, you don't have to do anything because your premiums are based on risk variables. And so if you are writing more and more riskier customers, your premiums would go up as a result, and you don't have to change your base rate for it. It's already contemplated within a GLM. The third reason why you need a proposed rate change is if there is changes in the relationship between your risk variables and your targeted loss. And I'll show this with an example. So let's say your current factor associated with risky driving is 3. In other words, let's say that the loss cost of risky drivers, average loss cost of risky drivers, is 3 times the loss cost of an average driver, right? If cars become safer, if cars becomes more robust, then it's intuitive to expect the factor to go down from 3 to maybe 2.5 or 2 or 1.5. Why? Because even if you're a risky driver, the safety features, the automatic braking is going to decrease your frequency of an accident, right? And even if you get into an accident, the severity will not be as much, right? But when this happens, when the nature between your risk variables and your targeted loss changes, you can easily refit your GLMs to pick up the new relationships, right? In insurance, normally GLMs stay in production for about 3 to 5 years, but you don't have to wait for 3 years before you refresh your GLM. When you, as an actuary, when you feel like the relationships have changed, you ask for a refit to capture the new relationship. The third component, policy risk factor. So currently, we source the policy risk relativities from the GLM, which is good. The GLM is the best source for the policy risk factors. But what we do to them after we've got them from the GLM makes them suboptimal. So what do we do to them? So we get the factors, the GLM factors, and then we multiply to get something called risk score. And then we partition the risk score into something called risk score groups. And then we map the risk score group into something called loss ratio relativities. And it's this loss ratio relativity that we multiply with the base rate. That is a suboptimal culture that has to be stopped. We've already shown that the GLM estimates themselves are the most precise you can get. So when you multiply it together, that's the best product of your policy risk score factor. So that's the product you have to multiply with your base rate. You don't have to partition into risk score groups or even map to anything else. All right? Okay. So now I hope I've made the point that the GLM is the best source for I've gotten the 5-minute signal, so I'll try and wrap up. So here, I just wanted to take a step back and put myself in a devil's advocate shoes to talk about some questions that might come up. Someone might ask, what about actuarial judgment? For that, I would say that if you are expressing actuarial judgment to adjust for an effect pertaining to the future, then it's definitely apt. But if your actuarial judgment is to adjust for an effect in the past, then because the GLMs are built on historic data, it is already contemplated in the estimates, so there might be no need for actuarial judgment for that. And studies have shown that even the most simplistic models outperform the best human judgment. So you have to really trust your models when it comes to things in the past. For credibility, there is generalized linear models, and they take care of credibility within a GLM framework. IBNR development is already incorporated in GLMs, like when we model targeted losses, we develop them to their ultimate before we model them. I'm not going to talk about large risks because of time. Next slide. Why should you embrace the change? I'm just going to talk about one reason for the sake of time. You have to embrace this change because precision is important in insurance. And the reason why precision is important is threefold, in my opinion. The first is precision has got a leverage effect on your profits. Insurance has got one of the slimmest margins among industries. On the Gracious side, it's about 10%. So if you have a 1% in precision, that has eaten about 10% of your profit. 2%, that is 20%, right? So because of this leverage effect of precision, you want to be careful. Also, precision can cost you business. Insurance is a concentrated market, very competitive. Customers are price sensitive. So if you overprice a customer because of evitable imprecision, that is very painfully expensive, because studies have shown that companies spend roughly 15 to 30% of their premiums acquiring customers. So once you get them, you want to keep them. But the others, there are other reasons why you have to embrace the change, but I'm not going to get into it for the sake of time. Next slide. All right, so what does it mean to us as actuaries? First of all, I would like to applaud the actuarial programs for their increasing emphasis on predictive analytics, because I believe the data scientists would never be curious enough about actuarial science to use their acumen to solve, to develop solutions for actuaries. So the actuary has to step up and beef up his or her statistical acumen so that they can use it for their own advantages. However, I believe there is a need for a new role called the actuaritician. So I believe a subset of actuaries should be allowed to develop a first principle understanding in statistics so that they can use such profound understanding to develop statistical solutions specifically for actuarial use. You can think about the econometrician, right? This is a person who understands statistics as any other. They have a very, very profound first principle understanding in statistics, and they use it to create statistical solutions solely for economics use. And I believe we need to create such a role for actuaries as well. For the sake of time, I will bring my presentation to an end. But if you want to read more about my paper, the link is on the left-hand side. Apart from actuarial science, I also write about data science and some other things. You could also go to my blog and read about some of my other writings. But you've been great, audience. Thank you very much. I have been told that because of time there will be no questions. No, I'm kidding.
Model was, it took too much time and it brought too many arguments into the pricing area. And so over time, people loved it. I mean, I read the study note, took an exam on it, and I loved it. But the implementation was very difficult. Have you compared such an issue, have you thought through this as an issue for the pricing people?
Great question, Francis. Thanks for the question. Can you go to, like 3 slides from here? 3 slides back? Yeah, stay there. So I would point to my third reason. I think that's the difference between this approach. There is no transition cost. GLMs are widely used in insurance already. It's something that, I had taken a lot of advanced statistics, but I did not learn about GLMs until I worked in an insurance company. So actuaries actually taught me about GLMs. So there is no learning curve here. Actuaries know about it. The only problem is when we get the base rate from the GLM, we throw it away and rely on the actuarial base rate. All this change is saying is that we should take a critical look at that base rate because it's very precise.
actuarial. That's a new word for me, isn't it? So when I get to work on Monday, I'm going to go into the actuarial department and ask them, apart from my chief actuary who's here, who's heard it, I'm going to ask the guys in the actuarial department whether they have the word actuarial. That's a new one. Thank you, Jesse. Quickly, let's take the next presentation from Peter Fauci, who works with QUD, and he's going to talk on the topic liquidity management for insurers, opportunity risk, and appetite. So Peter, if you're ready, 15 minutes.
Good afternoon, all. My name is not Peter Fauci. My colleague Peter is at the back. He's decided to be a slide master for the first part of the session. But it's very encouraging to see so many people still here on a Friday afternoon. Before I get sidetracked, my name is Yolan, and today we'll be presenting on liquidity risk, and in particular, a process for managing liquidity risk. So on the agenda, I will cover what is liquidity risk and is it a concern? And Peter will go through the more practical elements covering the liquidity risk management cycle. So what is liquidity risk? Liquidity risk arises when an organization has insufficient cash flows to meet liability obligations as they fall due, or they might have sufficient assets, but they're not able to sell them at the optimal price. And this can be further broken down. This can be further broken down into two elements. So funding liquidity risk, which refers to having insufficient cash flows, and market liquidity risk, which refers to not being able to sell at the optimal price. So there's a number of principles that we have for liquidity risk. We've come up with a list. It's a comprehensive list, but it's not exhaustive. So principle one, it's not your fault, but it's still your problem. So market liquidity risk is not necessarily your fault. You can't control where the market is at a point in time. But funding risk is yours. You should have adequate liquidity frameworks in place to manage your cash flows. Two, you have more than you need until you don't. So liquidity can dry up very quickly. An excessive market shock can deplete your liquidity very quickly. Too little liquidity kills you quickly, too much slowly. So there's an opportunity cost to having too much liquidity. Yes, it's great to be in a strong liquidity position, but then you expose yourselves to the impact of inflation. For example, at 10% inflation average for 4 years, and a 100 steady investment would result in a real result of 68 after 4 years, assuming no investment income on that cash. Liquidity risk is operational and consequential. So liquidity risk arises from your daily business operations, but it can also be from a knock-on effect from other risks like reputational and credit risks. So essentially, there's an element of it that's out of your control. Regulation is necessary, but not sufficient. So liquidity is a part of regulation, but we find it's not generally a key focus area. Often, solvency is the key focus. Scenario analysis is the language of liquidity. So scenario analysis is the main way to test liquidity. Often you'll find that organizations only have liquidity issues in adverse economic conditions. So it's important that you have a sufficient liquidity buffer to allow for the additional cash flow requirements under a stressed event. Liquidity risk nets zero for the system as a whole. So during adverse economic conditions, one organization will gain liquidity by taking that liquidity from another organization. So during a market liquidity crisis, all organizations will want to hold on to their liquidity. So it's difficult to gain liquidity. Cash sources and uses are fungible. And this essentially just means that there's different ways to improve your liquidity. You can improve your inflows or decrease your outflows. Confidence is the likelihood of liquidity. Confidence is key. So often banks are adequately liquid until the market believes they're not liquid. So if you believe your bank has issues, you'll immediately start taking out your cash, and that's when your bank will have liquidity issues. Liquidity risk is heterogeneous. And this essentially means that liquidity risk is different for every organization and that it can be decomposed into many different parts. So should we worry about it? This slide just depicts the maturity transformation that occurs in banks. We deposit our liquid assets into banks, and this becomes the short-term liquid liability for them. And then they transform this into long-term illiquid assets in the forms of loans and more. So essentially, and this is the problem with banks, that liquid assets are converted into illiquid assets. And then if there's a concern with the market and with the banks, everyone wants to withdraw their cash, and then all of a sudden there's no liquidity and there's a run on banks due to market confidence and contagion risk. Further to this, that there's added complexities with the complex products that banks have. Okay. So we understand that liquidity is an issue of banks, but what does it mean for insurers? Insurers take on liquidity by premiums, usually in advance, and they give out liquidity by paying claims and expenses. Hence, they take on liquidity risk in the form that their premiums and their liquid assets are not sufficient to meet the claims and expenses, or there's some contingent event that they're not allowed for. Going a bit deeper, or a bit of a high level into the specific insurance type, so general insurers, covers are mostly annual, they have large amount of assets in liquid investments, and hence they can match their cash flows, but they have liquidity risk from catastrophic events, large outlying claims, unexpected events, or concentrations of investments. They transfer some of this risk through reinsurance, but this adds some other risk in terms of default or delayed payments. On the other hand, life insurers have long-term covers and they have less proportions into liquid assets. However, they have liquidity risk in the form of policies being surrendered unexpectedly, mass lapses from reputational damage, investment activities not going as planned, changes in yield curve can have big impacts on net asset value, reinsurance dependency and concentration of investments. So in essence, the insurance risk in terms of liquidity may not be as large as banks, but there's additional complexities in recent times with the complexities of group structures changing, where in some groups you see that there's also banks in insurance groups and that take on leverage and hence increase the liquidity risk that in insurance business. What the slide is basically trying to say is that essentially a lot of liquidity risk comes from external events. Again, it means that you may think that liquidity is not an issue and you have it managed well internally, but there's external shocks that you can't really account for, such as coming from the runs on banks, reinsurance dependencies, changes in yield curves, and political instability and financial crises. Yeah, so as I said earlier, liquidity is a concern for regulators. However, it doesn't seem like it's a key focus area. Solvency still seems to be the main focus area. However, we are seeing changes in terms of in regulations with further emphasis being placed on liquidity in recent times, such as the OSA, South African regulations, etc. I'll now pass on to my colleague Peter, who I think he's mastered changing slides.
Yeah, thanks, Yolan. So I think what we want to talk about now is the liquidity risk management cycle. And basically what we're going to do is we're going to take the risk management cycle and apply that to liquidity risk itself. So let's start with identification. Identification of risks can usually be broken up into 3 dimensions. We look at the cause of the risk event, and then also the impact of the risk. So this will give us some way of describing how the risk can be identified. And we use usually 2 methods for liquidity risk to identify this. Firstly would be the risk control self-assessment, which is usually more operational in nature. So for instance, we can say, suppose there's a wiring issue in our building and the building burns down, then we will have to pay a big amount to make sure that our business is up and running before our insurance pays out again. On the other hand, the cash flow analysis is much more consequential. So we could say, as a result of our company not investigating and doing a cash flow analysis, we've invested all of our assets into property, and now that we've invested into property, our reinsurers that we have to pay, we don't have the liquidity to pay them. So we also have a liquidity strain in that situation. So in summary, the RCSA looks at an operational loss and likelihood and severity, whereas the cash flow analysis looks more at the consequences of not doing a cash inflow and cash outflow calculation. So let's look at the assessment, and I'm really going to try and go through this fairly quickly because there's a lot of slides. We're looking at two metrics. First one is a nominal metric, and that's called the liquidity shortfall indicator. And basically what this does is it takes the available liquid assets that we have within the company, and then we subtract the funding requirement that we expect over the next 12 months. However, this is a nominal value, and we need to recalibrate the requirement that we want very regularly. So we would rather like to have a scalable metric, and therefore we can have the so-called liquidity coverage ratio. So this metric, you can say it's the available liquid assets divided by the funding requirement, and you could say something like, I want the funding requirement to be covered by 1.3 times from available liquid assets. So let's look at the liquid assets. So the first tier that we're proposing is cash, and cash can be immediately used to pay for liquidity stresses. Our second tier is treasury bill, government bonds, and listed equities, and these can be relatively easily transferred from an asset to a liquid asset. Then tier 3 is for corporate bonds, and then the fourth tier is properties and private equity, which is fairly illiquid. However, we cannot use these as they are on their own to calculate our available liquid assets. We need to apply something called a haircut. Now, the haircut is the same as what Yolan was talking about for the market liquidity risk. The market liquidity risk is saying that depending on how quickly we want to transform our illiquid assets into liquid assets, we'll need to reduce the value and sell the asset at a lower value than what its market value says it is. But I also want to say that this is now our proposal for a typical portfolio, but it's important for the company or the insurer to make sure that the tiering is appropriate to their company. So it's almost like doing an ORSA, where you make sure that how you believe your assets can be easily transformed, you can quantify that. So let's look at how you would calculate available liquid assets. So on the first column, we have our portfolio of investments, we have the market value of those investments, and then using the tiering that we just spoke about, we tier those assets in the third column. Now we've used arbitrary haircuts and said that the tier 2, for instance, has a 20% haircut, the corporate bonds have 40%, and the private equity and property have a 50% haircut. So to calculate the available liquid assets, we then have to take, say, for instance, 20% off the listed equity. That means that we have an available liquid asset of 120 instead of 150. Another important point to make is if we were to decide that we only want to look at a certain tier or a group of tiers to look at whether our available liquid assets are appropriate, we would say, for instance, for tier 1 to tier 3, we'll only look at the top 4 rows, and if we wanted to just look at tier 1, we would only look at cash. And I think that's the traditional view that a lot of insurers have taken, is that the tier 1 cash asset is the only available liquid asset. And then just to reiterate there at the bottom, The haircut size also depends on how quickly you want to convert your illiquid asset to a liquid asset. So let's look at the funding requirement that is expected over the next 12 months. Just quickly, basically what we do is we use a funding requirement matrix. We look at all the expected cash flows over the next 12 months, and then we calculate the funding gap based on what we see. So there's the funding matrix at the top. Important to know that we include all of our cash inflows and outflows, make sure that we don't use accruals, but actual money that moves around. We calculate the difference per month, and then we sum for each month that we expect to get the total funding requirement that we use in the LCR or in the LSI. And then this can give us a view of how our funding will look over the next year. So you'll see the dark orange blocks are incremental. So it says for the first month it's got a positive funding requirement, but say for instance in month 5 it's got a negative funding requirement. But the light orange is cumulative, and that's maybe the one that's more important, because we want to make sure that we have enough cash flows building up until the end of the year to cover our expenses and outflows. So we've looked at the cash flow analysis, and now we want to add some complexity. So let's add stresses to our calculations. So we allow for stresses in our cash flow analysis because we know that our assumptions won't be the same as what we expect or what will actually happen. And we want to add robustness to our calculation. So looking at the stresses, we usually look at what cash inflows and outflows there are, and then we apply that to the funding matrix. So let's look at tax changes. Let's say, for instance, taxes is changed by 2%. So we add the tax to the outflow, we increase it. That increases the total outflows, which increases the funding requirement, which reduces our LSI and LCR. So to sum up, the LCR is the ratio of available liquid assets at a given group of tiering allowed for a haircut. It's divided by the funding requirement calculated over the expected 12 months, and it's stressed as well, as if it has occurred. Quickly looking at the management, so we can only manage something in the risk management world if we can assess it, and we have to add a risk appetite statement so that we can say what is the level where we're happy with our risk or our KPIs and KRIs to see if we're within or without our appetite and whether we need to manage it. So a qualitative one would be easy. We could say the insurer needs to meet all liquidity requirements under all stresses for a group of assets. And then we will use the LCR or the generalized LCR, which we'll discuss in the next slide. But we don't have a quantitative risk appetite statement. So the GLCR is calculated as the minimum of all the liquidity coverage ratios, and that includes under the stresses, the base projection, as well as the regulatory requirement. So now we can say our quantitative risk appetite statement is the company has to ensure that it has a GLCR that's greater than 1, or its LCR should be greater than 1 for all possible scenarios. And it doesn't have to be 1, it could be 1.3 or 1.5, but we have our quantitative risk appetite statement. And using that, we can now institute management action. So suppose we're below our risk appetite statement, we can get a capital injection from the shareholders. We can try and acquire financing from a bank or some other organization. We can defer our payments, so we'll pay salaries, but we defer our payments to other creditors. move our liquid assets to liquid assets, but at a haircut, as we discussed, or we have to change our reinvestment strategy, where once illiquid asset matures, we will then reinvest that into a more liquid assets. If it's within appetite, we're happy, there's no action required. And if it's over appetite, it's, as Yolande said, we can either give it back to the shareholders, or instead of incurring operational opportunity cost, we can invest in a lower tier asset that will give us an expected higher return. Monitoring, fairly easy. We set out a management action plan, assign an action owner. For each action, we set a deadline, the actions are measurable, and we review those regularly. And how we would review that is we'd first send the completed action plan or the action plan that still needs attention to the ExCo. ExCo reviews and send the prioritized actions that are required to the Risk or Investment Committee, and then they inform the board of what they find pertinent. And then finally, we look at reporting. So reporting would be a dashboarding exercise. We'll show, for instance, the stresses with the LCR and LSI in the top left corner, the management actions that we're going to take in the bottom, and then a dashboard for the risk appetite. So just to summarize, the identification is done through the RCSA and the cash flow analysis, assessment through the LSI and the LCR. Management action is the risk appetite and action plan. Smart action plan should be used and escalation for monitoring, and then reporting is done through stresses and dashboarding. Thank you. Is there time for any questions? Does anyone have any questions?
Thank you very much. Thank you very much for your presentations. I think I really appreciate it. What I want to ask is, how do you manage this liquidity when you have a major contributor to your pension scheme being a government who doesn't make contributions for 8 months, a year? Do you have to be liquidating your assets, or what kind of experience do you find in that sort of environment where you have liabilities you got to meet, you can't give excuses? Yeah.
So I think that's a difficult question to answer. It's very similar to if you have received from your parents an asset that is illiquid in nature, and you need to do something with that, but you can't sell it because I guess the idea is, as Yolande said, in an insurance company, we tend to have liquidity at the start, and we have to just manage that to make sure that during the year, our outflows are not greater than our outflows aren't greater than our inflows. And once there is a problem, we need to take that management action. So you may have to go for lending, ask the shareholders for more funds or something like that. Maybe Yolande, you can add to that. I don't know if that's a very difficult question to answer if you're so constrained with. Yeah. Yes. Yeah. Yes. Yeah.
Delaying the contributions coming in. How do you go about that particular? Then I saw in one of your slides you said that the shorter the tenure or so, the higher the haircut. I thought it would be the longer, the higher the haircut or so, or something like that.
Sorry, can you repeat that?
You said that in one of the slides.
Yes.
You showed that is the shorter, the higher the haircut. Where you were talking about a haircut
I was
scenario
talking about the haircut.
on the footnote.
Yeah.
you indicate the shorter, the higher the
The quicker
haircut.
you want to sell your illiquid assets,
Yes.
so the quicker you want to get rid of it,
Yes.
it means that you have to take away more from the market value to just get it sold, so that you
Okay.
get the asset that's more liquid into your portfolio.
Oh, okay.
So that's
okay.
that's what we
okay,
mean
okay. So
with,
the,
with
okay, the
short
quicker I
term.
want, the higher. Okay.
Yeah.
But my first one, I still.
Can you build a model to mimic the government's behavior in their contribution payments? Because it seems like it's a random walk. You don't know when you're going to get it. So maybe if you look at history and look at the economic factors prevailing, you may be able to some extent know what the delay is going to be for this year. Yeah.
Yeah. I think that's a very, very good point and helped us out a little bit. But yeah, I think that's a good point. It's a difficult one to answer. We say you have to stress test and you can use the FCR stresses. But yeah.
Okay, just to add a little. So, continuing from where Mr. Nketia said, left, it becomes chronic, in quotes, if the model shows that this is the practice, and over time, the government has not been able to live up to its expectation, and it's becoming an issue for, raising liquidity issues. Probably to be a time to start thinking about how to get extra funds into the scheme by probably adjusting or recalibrating and getting the contribution rates upward somewhere, using other methods to get more money whilst you work towards getting these locked up funds, if you like, and to make the system run.
Yes.
That's
So you build up like a reserve and
exactly.
Yeah.
Yeah.
Thank you. If I can go as well. Thank you so much, gents, for the presentation. I'm curious about how you calibrate your stresses. In view of things like COVID, which are probably, maybe rare events. How do you deal with that?
So I think that's an important question. Like that's typically something you would see in the ORSA, where you would say how does this affect the company? And the problem is usually when we do modeling, we do it on an accruals basis. So we look at what's the impact on the income statement, what's the impact on the balance sheet, but we tend to forget to look at what the cash flows, the actual money in the bank is. So I would say your model should allow for the interaction between the balance sheet and the income statement, so that, or that's just the first part of the answer. So just to ensure that your cash flows are actually happening, and then you should parameterize your stress in the same way as you would on a ORSA or on an FCR. So you would say premiums will go down, our claims will go down for a little bit, and then it will catch up a bit later. Our expenses will be slightly lower for the first few months, and then it will increase again. And then just make sure that the interaction between your expected income statement and your expected balance sheet correspond through a cash flow statement that directly looks at, say, what portion of your premium is going into cash and what's going into a premium debtor. So that's my proposal on the spot. Okay. Thank you.
Thank you. Evolve Africa. I'll give you 60%. You do a reset for this exam. One more presentation, and we'll draw the curtain on this this session for the day. And quickly, we'll invite Mr. Francis Nketia from Rocky Hill Group to give us a presentation on enterprise risk management in pension.
Thank you. Getting back to the last question you were asking, I've seen you in the newspapers on the web suing other enterprises. Why don't you sue the government so they pay you on time? I know that's a non-starter. but in this part of the world, I'm going to be talking about enterprise risk management as applied in pensions, and I've been warned that I better make it snappy, to draw the curtain down. I'm an actuary. What jokes do I have? But we'll see. I saw this quote many years ago in reading an article from FI, one of the publications, and I really liked it. And what I got out of it was, as cocky as we are as actuaries and whatever we do, we so much believe in it. This guy is telling us that whatever we do is just it has predictive power, but it won't turn out to be the truth. And it's never been in my 35 years. So I learned a very good lesson from this guy, even though he's not an FSA, he's just an FIA. Let's go to the next slide. Okay, since we're going to be talking about pensions, I felt like let's step through a few things about pensions. Pensions, generally, you have the sponsor, and I'm going to be speaking from the sponsor's point of view. You have the sponsor saying that he's going to deliver these benefits somewhere along the line in a person's working career or after. And they know very well that it comes with both financial and non-financial risk, but they still go on to take it. Let's take a look at the forms of benefits that you can draw. You have the defined benefit, the defined contribution, and hybrids. I don't know if there are any hybrid plans in Africa, but whatever it is in the US. It's just a defined benefit, but instead of the employer taking all the financial risk, they'll tell you that you have an account, just like defined contribution, but they'll peg it to an index, like the movement in the Ghana stock market. Whatever the increases are, that's what you get. And by the time you retire, whatever the account value is yours. That's what the hybrids are about. Okay. Let's get to the real meat of this, ERM. What is ERM? Basically, companies have been doing risk management for ages. And it's worked to an extent. But they were done in silos. Most of you probably worked for insurance companies before. Underwriters will do theirs, actuarial department, financial people will do theirs, pricing people will do theirs. And it was never looked at from a company point of view. Everybody did their own business. And what you see is, if you go into ERM methodology, you are looking at even correlations. If this thing happens, does it reverberate through other places? Or do we have something that offsets it? You go through all of that to make sure that you understand the nature of risk within that entity. That enterprise, you've covered every base. And something happens, you know that it may get to this area in 2-3 months. So you are very much aware of it, and you move over there to try to stop it. Let's go on. Why ERM? ERM gained popularity right after the financial crisis in 2008, when companies went back to do postmortem on why they were hit so hard. What most of them realized that these issues have been raised in different departments, but nobody ever coordinated it for the big guys to know that, geez, the multiple of these can really kill us. And I can talk about one company in the Hartford. These guys did risk management better than anybody. The models they had, they were a sight to be seen. But when it came, they suffered the most because they never coordinated their risk. And what you will find in ERM is an ever-changing, it's an evolution. You may have something now, but you continually look at it and change it, look at what others are doing, and if you're missing anything, because it's fairly new. If you're talking about 2008, this is not the actuarial formula that Jesse Dapar was talking about. So it is an evolutionary thing that is going on. But so far, as you will see in an example, a case study that I will show at the end, not in pensions, but you'll find out that it really works. The last presenters went through this process, ERM process, that is identify the risk, assess it, mitigate and manage, measure and monitor, and report the risk. Most of these ERM things end up in what we call a risk register. And that will be the next thing I show, and that's where I'm going to spend most of my time. And what you see is, if most people believe in ERM and do not treat it as one of those boxes to check, a compliance issue, but they totally believe that it would help manage the company, you start reaping benefits from it. Because take a look at AIG during the last financial crisis. AIG had about 600,000 employees. There was a unit that had only 300 employees, but consistently they were producing 25% of the profits. Nobody ever took the time to ask, how could 300 people produce 25% of our profits and the other 600,000 doing only 75%? What kind of risk are they taking? Should we? And later when they did postmortem on it, they realized that people in there have been raising concerns about the risk that finally almost killed the company. That if you're going to insure somebody's risk and you're telling them that if the risk goes, what they were doing was they were insuring bonds in the simplest term. And what is said in those contracts is, if the bond value goes down, they are supposed to put up the difference. So if it falls from $100 to $70, they are supposed to put up the 30. But in most cases, when there was no panic in the market, the holders of those insurance never called for it. But when everything was going down, and they saw that, oh, that bond is at 80. No, I need that 20 now, because everybody is panicking. I'm not going to sit around and wait for it to go up. All of a sudden, they owed over $80 billion that they didn't have. The federal government had to step in and bail them out. So that was the kind of thing that when people were raising these type of issues within that 300-person unit, it should have gone to management. There should have been an ERM process where they would have known about it. Maybe they were producing 25% of the profits, but at a certain point, they would have called for very, very careful underwriting and maybe taking this provision out of it. That no way, we can't continue doing this. We already have 20 billion that we may have to put up, and we don't even have the 20 billion now. So let's go to the, I have a quote here. Sunshine is the best disinfectant by Louis Brandeis, late US Supreme Court Justice. Basically saying that everything, you have to shine the light on it. And that is the, something that ERM does for you. Because I was a risk manager at one point with international reinsurer. And you go to one of these meetings, you put out your cash flow testing and ALM stuff, and you get an underwriter. Did you guys know that you were going to be short of money at this point? And I'm like, keep to your underwriting. We know what we're doing, but you have to answer the person. You know, so all of these people start understanding the type of risk that goes on within the insurance company. It's not just you who controls that. If you've got an underwriter questioning you on some mismatch, you know that you better not bring too many of these there. Let's go to the next slide. This is a very busy slide, and I hope this is where I'm going to spend most of my time. How much time do I have left? 10 minutes? Okay, good. I think I can do a good job. This is the identification process. You see that in the box there. You know, each department, administration of the pension plan will go through and say that, okay, poor record keeping is a risk. Who is the manager of that? Plan admin, the administrator. Incorrectly calculated benefits. That's the actuary's job. Over budgeting, spending too much on the pension plan. Fraudulent dealings, and all these things. Then you get to the investments. You got interest rates and all of that. Who is responsible? And you go to biometrics and regulation, mortality, liquidity, top-heavy plans, sponsors, continual funded. Yeah. Would the company be able to fund a pension plan in the long run? Because that is a risk. Lots of companies in the US terminated their plans and handed it over to a guarantee fund. And there, if you were supposed to get $1,000, you may end up with 500. At least you got something. And you've got regulations, if there are regulation changes in the management of the pension plan, how would it affect you? Who is on top of it? Who is going to make sure that the whole system get to know about it quickly? And if you mean to go in and lobby, who will be doing that? Then you go to the assessment part. This is where you're looking at probability of that thing happening in the immediate future. You will say medium. What does medium mean? You have to define it. Maybe between 2 and 5% of occurrence, you call that medium. Above that, you may call it high. Maybe below 1%, you call it low. It depends on how you want to define these things. But within that, you will know how to manage it when you set those limits. And you do the same thing for the financial impact. You know, would it kill you? Would it be catastrophe? Would it be major? Would it be minor? And you combine these two to get this column. In the end, the whole group has to decide, are we going to retain that risk? Are we going to work very hard to reduce it as in risk management? Or is it too much for us? Would we buy insurance on it? And that is the risk transfer. So you go through this, you go through these type of exercises. It doesn't take just one shot at it. You have to go through it for about 2, 3, 4 quarters to really get a good handle on how to do this thing. Once you're done, there are usually quarterly meetings where you got leadership who will go ahead, take a look at this, have these guys argue over what is going on in the market. Somebody talking about the longevity risk. If they've seen anything that shows that they're going to have longevity risk in the future. Or mortality with COVID. Did you gain anything? I mean, I know mortality is bad, more people died, but if somebody's gone past their guarantee period, you're free from any more any obligations to that person, you know, if they're gone past the guarantee period. So you will have to put all of that together and make management understand what is going on, and other people pitching in to make sure that they also understand that what you are doing has no effect on their line, and their line also doesn't have any effect on it. If it does, they understand it enough on how to move if anything hits. And this will be condensed down for the board to understand. I mean, things that come in as low are not going to go to the board. But the ones with the medium and high, depending on what the risk owner thinks of it, and the trustees and other things have thought through it in earlier times, it may go to them or not. So this is the tableau that is used in managing ERM. Let's go to the next. Oh, before you go, can you go back? If over here you see the unsuitable benefits, and I thought you would have a good laugh over here. Even though I'm an actuary, I think I'm going to try to make it fun. And then as a liability manager, I believe the previous presenters did a pretty good job on that, but in particular with regard to liquidity. So let's roll to the next slide. Okay, what I've seen is in almost all the African countries, they take the old form of benefit payments. You get a guarantee period, and then you live. If you live past that, you get benefits until you die. 10 years, 12 years, 15 years. But that is the simplest way to do it. And it doesn't necessarily suit everybody. So I did some calculations to show you guys that you may want to change it because it doesn't suit everybody to have that 12, 10-year guarantee. Why do I say that? Because for this presentation, I use a male who's retiring at age 60 with a spouse who is 55, which for Ghanaians and most Africans, I think, if everything is normal, that is where things come in. So let's look at it. If for the 10-year, 12-year, or 15-year, the actual benefit is 100. We all went to school, in college and high school. We knew some people who are walk alone. This person doesn't care, probably will never get married, will live his own life his way. Why do they have to have a certain period? If they go for life-only annuity, and it's a 10-year, instead of paying him 100, you can pay him 111 a month. If it's a 12-year, you can pay him 116 or 124. So let him have that option if he is a walk-alone guy. Because that money, he may end up, if he dies early, he may go to somebody he's probably never given a penny to. So why does he have to bother with it? Give him his money, let him run the way he wants to run. And you can get 50%, which are fairly close, like the Ghana one. Instead of paying the person 100, pay him 93. If he dies early, his wife will get 50% of this 93 for life. You may talk about expenses, but how much do you pay in this day and age with electronic transfer of money to the banks? It doesn't cost much. So adjustments can be made. And the same thing, if they want 75% of this, it will be of the 89, they will start with 89. Or if they want to keep it the same way, 100%, they will start with 86 instead of the 100. And whoever dies, the surviving spouse will get the same 86. So they're not really bad, if you look at it. But then, if somebody is trying to pull, what's his name? The guy on CNN, Larry King, and he's 60, and the spouse is 35. Well, for the Ghana one, he only gets 60%. So for the 100, he will end up with 60 cedis for the month. Because the wife is so young, and Larry didn't last that long, you have to pay the 35-year-old for until that person dies. So it gets reduced by a wide margin. And I think most of the pension plans should look at these things and offer them because they're not expensive. But for some people, it'll be more suitable than getting the 10-year. Look at the 12 years. Somebody is 60. If he dies at, 71, the spouse only collects for a year, and there's no more pension. But the spouse may want to talk it through and say, we'll take 93, and if you die, I get 50% of it. That will probably be a better, more suitable benefit to some families. Can we go to the next one? I tried to bring in this cash flow ALM profile, but they talked about liquidity. These are annual projections of cash flows. The asset is in blue, and the liabilities are in red. And what you see is in the beginning, there's a dip where you pay more than you have in asset cash flows. So this is where somebody may question, were you guys aware of this? And you're going to use new money to cover these things when interest rates are high and we could have invested that money. Now you're using it to pay claims instead of matching these early on. And you see how the net cash flows go till the end. These are where the asset liability management people come in to make sure that they can manage this all the way through and also stay profitable and not get into negative liquidity issues. Okay. The next slide, please. Okay. took a look at two cases, and I'll do it quickly. The U.S. airlines, where they sell commercial airline tickets, the ones you can get on the internet, since 2019, because of the ERM regime they've instituted, there has not been one crash among these airlines, none. And each day, they have more than 20,000 flights a day, takeoff and landing, more than 20,000. They've done this for 14 continuous years without any incident. Why? Because they've gone through a very rigorous thing. You know, if you multiply 20,000 times 365 times 14, you will see the magnitude of what they've gotten right. And they do this. There's been one fatality on Southwest Airlines when, for some reason, the engine exploded. Something went and hit the side of the plane and killed a lady. But the plane was able to land and everything was fine. Just an unfortunate situation. What have they done? They go through strict training. Every incident must be reported. And if it's grievous enough, they will go through a training session on it. Double and triple checks before departure. I remember 5 years ago, some of the airlines were complaining that they are redundant and they're costing the passengers about 30 to 40 bucks. I read it, I go, please keep it that way, I'll pay. If this is what you want to talk about, don't go and reduce this. Let them keep it 30, 40 bucks. I'll pay to make sure that for the rest of my life, I'll never sit on the plane and panic, if that's what it takes. And lastly, let's look at the Texas guys. The person who put the FBI training together for active shooter, what just happened recently in Texas. And she is of the opinion that these guys, because they live in a small town, took the training and everything as a compliance thing. That, come on, if New York and Los Angeles people are shooting themselves, what has that got to do with us, that you have to put us through this training? Because they had been to a training session 2 months before the guy showed up to shoot up that school. And they did practically nothing. So if you're going to do ERM, you better make sure that you really have it inculcated into the people who are doing it. Because this guy stood outside thinking that he wasn't shooting anymore, not thinking about the kids who were down there. Some of them could have used medical help to survive, but they waited for over an hour and a half before they were able to get them to the hospital. And that is when you see that it was a routine thing for them. They were in a small town. Nobody kills anybody. But for once it happened. So even if you think the risk that you have within your line is something you've got managed, well, you got under control. Please always pay attention. Take it as a must, not a routine thing. Thank you very much. That's John Robinson.
Thank you. Would you go back to his slide on the benefit options, please? Okay. Thank you. Francis, my question for you is not directly related. By the way, thank you very much. I think you did an excellent job. But I just wanted to make a comment on the benefit options. The 50%, 75% JLS, 100% JLS. And as you well know, the US pension law requires that when one retires, if one is married, then you have to choose a JLS option, with the only exception if the spouse agrees to forego it. So I just wondered whether, and the whole point of that is to protect the interest of the survivor. Now, you gave a nice example where the male is 60 and the spouse is 55, and as we know, female spouses we tend to live longer than the male. So if you only did a life only for the male, then the spouse might actually have quite a significant loss of income to deal with after her husband dies. So my question, maybe Ernest knows, is it the law here similar in Ghana? And I'm going to follow up with that. If not, should it be?
No. The law was made by all males. And in those days, mostly males worked in the formal sector. So it used to be 10-year guarantee. We call it certain period in the US, but a 10-year guarantee in life. And when they went through the last, changes in the scheme, I had written an article to the Bediako committee that they should get rid of it. The next thing I know, it had gone up to 12 years. Because once again, they don't see it as their problem, and it's easier to manage than go through JLS. In the US, the spouse would have to sign it. Whatever option you guys are choosing would have to sign it, so there's no way around it. And if the worker was a female and the spouse will usually be older, these percentages will go up. Because generally, the man wouldn't matter, that the female will live longer on average. So it will be more like her getting life only. Yeah. Yes.
Thank you very much, Francis. So,
okay, go ahead.
Yeah, I'm curious. Thanks for the presentation. When it comes to this topic of ERM, this one slide you showed where you had the quotation on the sunshine, your last point, quite critical around culture of this, having this embedded in the organization and everyone
yes.
singing from the same hymn book. What are the trends? Do you see that there is better adoption across organizations? Because I know when the topic started coming through, it was quite difficult, even
yes.
for boards to actually appreciate what's going on with respect to this.
Yeah, I think over time, most people are buying into it. And the reason why they're buying into it is it becomes very embarrassing if you miss something and you didn't point it out, and the auditor comes in and points it out. The next meeting, either you call in sick or work, or you're going to hear from your colleagues. So most people are living up to the true tenets of the ERM, because you don't want somebody else finding out something about your line of business while you have quarterly updates for your colleagues and you missed it. So gradually it's getting there. I know it was difficult in the beginning, but it's getting there. Francis, let me give... Yeah. Yeah. Okay. One of the slides, I don't think I hopped on it, but what you see over there is this thing comes from the board. And almost in all companies in the US, the risk manager over this, he doesn't report to the CEO. He reports to the board, committee on risk. So when he puts his report from these meetings together, the CEO doesn't even see it. He meets first with when there's a board meeting, he meets first with the risk committee before they come in and inform the rest of the board, including the CEO. So when things come from that angle, and you're a line manager and you want to resist, I guess, if you prefer suicide, try it. Yeah. Any other? Yes, one last one. Okay, go ahead.
Thank you.
Okay, if you could start from the beginning so other people can hear you.
Okay, thanks. I think the main issue in Africa, most of the people who sit on the board seem to be very conflicted. I mean, I've worked, for example, some of the clients with, especially those with dual currencies. I mean, they will insist on dollar benefits when they know exactly they cannot find dollars in the market. But for them, it's just to protect themselves. And then the other issue is the issue, I'm glad that you spoke on the issue of the spots. I think we did discuss it yesterday or the day before.
Yes.
Yeah, because I mean, I refused to sign on something because I could tell that the evaluation does not make sense in the environment. Because I mean, the spouse differences we're talking of should have been at least 20 years, but they want to model on a 4-year difference. And to me, it's like, you need to convince me that 4 years is realistic.
Yeah.
So I mean, those are the things. I mean, even though we will love to take some of the benefit designs from the West, but the reality is that we need to make them fit for Africa. Otherwise, we'll be designing schemes that are going to fail in a short space of time.
Yeah, but unless you institute something of this sort, the funding will be done according to this type of methodology. And if we give breaks because we are in Africa, well, we're going to find ourselves short of funds eventually. So it's good to start off letting people know that we're not playing with this one. This one is about somebody getting to 95 and realizing that we've run out of money. So you're not taking it now. The money's got to be there. And you got to have a strong risk manager who can convey this to the board and the other people that this is what we will face if we continue along these lines. You know, we need to stop these things and do it right. Yeah. Thank you.
Thank you very much, Francis. It's been a great session, and for the non-actuary that I am, I need to be very honest. I really learned a lot listening to all of you professionals today and over the past 3 days. I think ASG has done extremely well bringing all the presenters to delve deeper into topics that most of you are already very much familiar with. And we do acknowledge the efforts of ASG. I think that we'll do well to just give all the presenters over the past 3 days a standing ovation. I think that we should do that for them, yeah. Thank you. We'll take a break and convene here in 15 minutes for the first ever Actuarial Congress Awards and Recognition event. But please, before we break out, one very important announcement. The president of ASC and our chief host would like to meet participants from the following countries at the foyer during the break: Benin, Tunisia, Senegal, Morocco, DR Congo, Zambia, Rwanda,